Hello and welcome. This week, we're going to talk about internal controls and accounts receivable. It's important to note how critical it is to have some idea of what you can do internally with your organization to maintain protection of assets, and also to allow your organization to promote efficiency and that the records that you provide to external parties are accurate and can be relied on. So an organization will need to have some form of internal control in place. Internal control is just a measure that organizations adopt to encourage employees to do what's right, to make certain that the assets, cash, and always your physical assets are protected from theft, and that the information that you put into the system is accurate so that people can rely on it. So internal controls has always been something that's very, very important. However, in the early 2000s, we did deal with a lot of issues with fraud, not only at the organizational level, but also within audit firms. And because of that, they had to pass this legislation, which in my personal opinion, if everyone was doing what they're supposed to do, we would never have to do a law to make you do what's right. Do what's right because it is right. And that's the thinking of behind internal controls. Do what's right and don't punish the whistleblowers. Protect those who see wrongdoing and report it. But in the end, that was the whole guiding principle behind internal controls and how it became so polarized in the media. So internal controls is going to be your procedures, your control procedures, your risk assessment, the information system, monitoring, and environment. And let's talk about each one of these. Internal controls, you got to make certain that you have competent individuals working, doing the work. Make certain that their background checks have been done. Make certain that they understand what's expected of them, and they are held accountable for that. Making certain that the responsibilities are assigned with people who have the credentials and who have the experience to do the job accurately, and making certain that duties are not shared when they more likely ought to be segregated. We'll talk about that in a minute. And then audits, make certain that audits are done. And with public organizations, audits have to be rotated, meaning certain organizations have to rotate their audit firms. They can't keep those same firms over 10 years. It has to be every few years that they have to rotate them. And that's important for independence, for neutrality, and also for transparency, which is a big, big deal. If you want to say, I am doing what's right because it's right, I have true internal controls. Documentation, electronic e-commerce. Now, today we're doing so much using the internet, using sources like mobile apps, etc. And it becomes absolutely important to ensure that these internal controls remain in place, monitored, checked, and changed as necessary. So obviously, there are some limitations to internal control. If two or more people working together to conspire, one would say internal control is seriously impaired by that. And there's really no good way to prevent it. In fact, it's the best way to deal with collusion is when someone is a whistleblower, which is why there are whistleblower protections, so that the people who will know that something's going on can report it and get an investigation. Obviously, small micro firms have a very, very serious problem with internal control because they cannot afford to hire all of these different people to do jobs to make certain that things are segregated. So you have to do a weigh against your costs and your benefits to ensure that this is something you can do, and it's likely that it will be more beneficial than it will be costly. So in terms of that, you have to make certain. Internal control for cash receipts. Again, we want to protect assets. Assets are liquid. Assets are like physical, like again, desks, computers, and if you're talking about a Walmart clothing line, merchandise, or technical things like your mobile devices or firearms, etc. Those are assets, and the organization needs to protect them from theft. And yes, people do steal. They steal from organizations, so we can't rely on, I'm going to be honest, we have to make certain that we are honest, and we can find out if they're not honest. So making certain that the cash receipt is a big thing, which is easy for people to steal, generally speaking. Making certain that you have some internal controls in place, like the ones listed here, will be very, very helpful to an organization to not avoid someone trying to steal, but if you can avoid someone trying to steal, you can at least have in place some procedure to detect it. And that's even more important if you can detect someone doing something wrong. Because again, you don't always know who's going to be honest. You hope that everyone that you hire is honest, but at the end of the day, the controls do help you catch something when something's going wrong. Again, for payments of cash, the most important thing is when you're dealing with payments of cash, you don't want a person who approves the bill to be paid the same person who signs a check or who generates the check. You want those people, those positions, and those types of functions separated to ensure that no one can fictitiously create this accounts payable vendor that doesn't exist and then start writing checks to oneself. Again, it's all about being very careful on who does what and making certain these duties do not overlap, will provide you with custody and authorization within the same individual. Bank reconciliation is another tool for ensuring accuracy. It is not a preventative measure by no means. It is a measure that by which you can actually see if the internal controls are working. That's all. Because reconciliation is always after the fact. And again, you want to prevent, not necessarily catch it after it occurred, but sometimes that's better than nothing at all. So again, evaluating an organization, making certain that they have clear controls on segregation of duties, who can approve and who can authorize, and who actually has the custody of the physical asset, and the flow of how bill payment process is occurring, and then following that up with reconciliations done timely at the minimum month to month. Again, evaluating an organization cash flow is going to be important for short-term needs, but also for long-term needs. The most important thing with evaluating a company is, can they pay their bills? Are they paying their bills timely? Very important questions. So that is something that you need to think about and consider. When you're talking about internal controls, you want to protect your assets. Assets mean cash. Are you liquid? Are you paying your bills when due? Have you have duties are segregated? Those are kinds of things that you need to think about and design controls to prevent any type of theft. If theft does occur, despite that, have procedures in place to catch it quickly. And again, all of it working together helps an organization be viable. Receivables, there are a number of receivables, obviously other receivables like taxes and dividends, but there are notes. A note is generally a promissory, a promise with an interest rate tied to it, that you're going to pay a certain amount of money within a certain period of time, and you'll pay for that privilege, and that's an interest rate. Accounts receivable are generally operational in nature. They generally do not have an interest rate tied to them, and they're most likely going to be non-secured. Sometimes notes receivables are secured, so that's very important to note. But these are expectation of some type of future benefit, which is in turn the definition of an asset. So when you have your accounts receivable transactions, again, we are talking about accrual-based accounting. So when we earned the revenue for a service that we provided or a product that we provided to a client, it doesn't matter if we get the money at that time. If we don't get the money, we have an expectation of a future benefit, an asset. In this case, we're going to assume that a company sells $10,000 worth of services on account. That means that they promise to pay us, or they are going to pay us within a reasonable period of time. So we have to say we have an expectation of an asset, and we have to show that we've earned the revenue. Factoring and pledging of accounts receivable, again, this is for organizations who want to maximize the use of their cash, and they need their cash pretty quickly, and they don't want to wait necessarily for 45 days or 30 days. So they may pledge that money, that receivable, to a factor who will give them cash. And again, all about being able to pay your bills quickly does rely on you receiving your monies from your clients quickly. And sometimes companies need to have it very, very fast. So 30 days may not be acceptable, so they might factor them, and it's all for cash flow purposes. But you do, in turn, have to pay for that service. So now, when we're talking about receivables for accrual-based accounting, we are going to be using the allowance method. The direct write-off method is not allowed for GAAP purposes. Writing off directly means that the receivable cannot be collected. They file for bankruptcy, and it has to be removed off the books at the time they know it's not collectible. However, for GAAP purposes, that's not appropriate. That's for tax purposes. For GAAP purposes, we have to use the allowance method. We have to create an estimate on allowance to determine if a percentage or guess a percentage of our receivables will go bad, and we have to write them off. And let's look at the entries. If we use a direct write-off method, we're going to immediately write off $500 because we know we'll never get the money. So we're going to debit our expense, and we're going to remove the receivable off our books. This, again, is not the method used within financial accounting. We have to remember this is more appropriate with the a tax basis, not for accrual basis accounting. This is not allowed. Now, the allowance method, again, we're going to be really using our matching principle concept when we think about the allowance method. We're matching the revenues with the expenses that was incurred. So we're matching them in the same period. So the allowance method, we have to estimate of what we think will not be collected within a period or accounting cycle. So that entry is going to be a bad debt expense, but it's going to be an allowance. Now remember, the allowance for bad debt is not an asset or a liability. It's a contra account. In this case, it contra against your receivable. So it's a contra asset account. It offsets an asset account. So remember that. Now remember, again, we are going to record what we believe to be a receivable that will not be collected. It is not, in fact, uncollectible. We're just guessing as to based on what we think, 10%, 12%, we think this is what's going to be written off because it's not going to be collected. And then when the account is actually written off or determined that we're never going to get it, we will remove the receivable and we remove the allowance off the books. The first entry is to record the allowance or the estimate of what the bad debt expense should be. And the second entry is when it's actually uncollectible. We know we're not going to get this money. And then we remove it completely from our records. So how do we estimate the bad debt expense? Well, there's percentage of sales, percentage of receivables, and aging. Again, if you think about the differences, each method is going to be recording your bad debt expense for the period and your allowance for bad debt. So the accounts don't change. It's the number, it's the calculation of what the bad debt is going to be for that period. Percentage of receivables is probably the easiest because all we're going to do is say, what is the percentage of receivables that we think are going to be uncollected? And they may do it based on 30 days, 90 days, 60 days, and what percentage under each category and multiply through and record the entry. However, percentage of sales is another one. It's very, very easy as well because, again, based on experience, the number of sales that we achieve in a period of time, we may think that 10% of those sales might go bad. So one is going to be the income statement method and the other is going to be the balance sheet method. So the percentage of sales, as you can tell, is on the income statement. That's the income statement and it's going to be the income statement method. So basically, we're going to be recording the entry debit to allowance, debit to the bad debt expense, and then credit to allowance. And the amount that we're going to record is only the percentage of the sale. 10% of sales are going to go bad. That's going to be our recording. However, with the percentage of receivables and agent of receivables, we are going to be using the balance sheet method. And what this particular method is going to be doing is calculating the actual allowance. And we have to record the expense based on the difference between what we recorded so far and what we want our true allowance account or balance to be. And we'll give you an example of that in another another slide. First, let's take a look at the percentage of sales, which is the income statement approach. If a business has $250,000 in sales for the year, $50,000 outstanding accounts receivable, $35,000 current, $10,000 30 to 60 days, $5,000 60 to 90 days, and a $2,500 debit balance in their allowance for a bad debt account. Assuming 1% of the sales are uncollectible, under the percentage of sales method, what's going to be your entry? You're just going to take the 1% and multiply it times the $250,000, and that's going to be your entry. The income statement method is far more direct, and it's a lot easier for students to get. So the only entry that I'm going to record is 1% of $250,000. That's $2,500. So my debit obviously is going to be my bad debt expense, and my credit is going to be my allowance for bad debt, which is my contra asset account. Now things get a little different when you're looking at it from a different perspective, from the percentage of receivables. Remember, this is the balance sheet method. And the balance sheet method is step one. You want to determine the amount to be included in the allowance account. So if it's going to be a 5% of your accounts receivable that's deemed uncollectible, if you're giving your accounts receivable balance, you're going to take that $50,000 in this case, multiplied by $2,500. That should be your ending balance in your allowance account. But now step number two, determine the bad debt expense for the year. The amount to be included in the bad debt allowance account, plus or minus already included in the account. Now I'm going to go back. according to this, it says $2,500 debit balance is already in the allowance account. That's very important. So now we already know that the allowance account has a debit balance of $2,500. So we're going to first determine that the allowance balance should be $50,000 multiplied by 5%. So our allowance account should have a credit balance of $2,500, but it has a debit balance. So what do we have to do? So let's think about it. If we have a debit balance and we want it to be a credit balance, we have to do something. So if we have a debit balance that should of $2,500 and it should be a credit balance of $2,500, what we need to do is add the two together to come up with our debit to bad debt expense and our credit to our allowance. So it's not necessarily more difficult. It's just that we are using the balance sheet method to determine what entry we need to record for our bad debt expense. Because we need to know what our allowance account's ending balance should be, to get to our ending balance, we need to adjust the debit or the bad debt expense. Since our $2,500 should be our ending credit balance in our allowance account, we have to consider what's already in that account. And we were told in the previous slide that the amount in that account is already $2,500 debit, and we want it to be a $2,500 credit. So we now know that we have to add those two numbers together and we credit the allowance for $5,000 in order for us to have a correct ending balance in our allowance account. Now let's reiterate this. When you're using the balance sheet method in determining how to or what to record in terms of dollar amount on the bad debt expense, you need to consider that first we need to multiply our percentage of uncollectible with our accounts receivable. That tells you what the ending balance should be. Then you want to compare that number to what's already in the allowance for bad debt account already. If the account has a debit balance, you have to add the two together to come down to the correct ending balance. If the balance, now let's assume in this same example that the allowance account had a $1,000 credit balance. What would be the entry we need to record? If we know that our ending balance has to be $2,500 credit, but we have a $1,000 credit balance, what you do is you have to take the difference. Your difference would be $1,500. I hope this example is helpful to you. My suggestion would be to do the examples in your textbook prior to jumping into the homework on Cengage. Look at the examples that you see. Remember, the balance sheet approach is your calculation is going to be the ending balance in your allowance account. And what you want to know is, this is what my allowance account balance should be. Now, I'm going to compare that to what the balance is already, and that's going to determine what my adjustment is going to be, or in this case, what my journal entry, bad debt expense, debit, and allowance for bad debt expense, credit. And here is another way to look at it. Again, using the agent of receivables, again, the whole point of it is, this is the amount of money that we want our ending balance in the allowance account to be. And in this case, we said 1% of the current receivables uncollectible, 10% of the receivables at 30 to 60 days overdue, 20% of the 60 to 90 days overdue receivables. And this is how it's calculated. Again, the balance in 30 days is $35,000, 1% of that, and $10,000 for the 30 to 60 days, which is going to be 10%. And the same then for $5,000 of your receivables at the end of the period at 60 to 90 days, and you take 20% of that. Add the three together gives you the $2,350. Now that's what should be your credit, your ending balance in your allowance account. Now let's take the same kind of thing here. In step 2 is, if you have a debit balance already and you want your ending balance to be a credit, you have to take those two numbers together and add them. So I'm going to take the $2,350 and add it to the $2,500 debit balance, and my credit to my allowance account is going to be for $4,850, and my debit to my bad debt expense is going to be $4,850. very different ways of looking at things, and neither of these different processes are incorrect. I would say most organizations use the most accurate method to estimate their uncollectibles, and they do have experience in seeing this is a pattern for us. Looking at our sales is a pattern of what our uncollectibles will look like, or conversely, looking at the aging of our receivables is a better guess based on experience of what our uncollectibles would look like. So all of these different methods are very, very useful, but one may very well be the most appropriate for the organization. So now, what happens if you write it off, or at least you completely wrote it off, and then somebody decides to pay and later on? So under the direct write-off method, if you already wrote it off, you have to first restore, right? You have to first restore the previously written off receivable. So under the direct write-off method, you're going to take and then record your receivable, and you're going to remove your allowance, your bad debt expense, and then record the cash coming in and remove the AR. Again, this is only because you're showing a restatement of a receivable or an account receivable that was written off previously. This generally will not be the case for companies because they're not going to be using the direct write-off method. They're going to be using the allowance method. Now, under the allowance method, we first want to make certain this receivable was completely written off, right? So we're going to write off, using the allowance method, we're going to write it off. Our debit to accounts receivable and our credit to bad debts. That's writing off that receivable. But now we have to restore everything back. So when we restore accounts receivable, first of all, we debit the accounts receivable and we credit our revenue. Then our allowance account, we have to create this allowance or this estimate of what our bad debt would be. We record a bad debt expense and record allowance for bad debts. Okay. Now, if that receivable was written off, what do we do? The first thing you need to remember is the entry that we need to record to remove a receivable off the books under the allowance method is we first have to reverse it completely. And that's going to be a debit to the allowance for bad debt and a credit to accounts receivable. That's the literal writing off of accounts receivable. Now, when a company decides to pay back that debt, even though it was previously written off, we have to now restore the receivable that was written off by debiting the accounts receivable and crediting allowance for bad debts, which is the entry you see, number 1. And then when the money is given to us, we remove the receivable by crediting it and we debit the cash. Now, what I would like to make a point of in this chapter is these little steps are not necessarily difficult. I suggest practicing them over and over with your problems in your textbook, because I think the more you practice them, the more it makes sense. The first thing we want to remember is if we're using the allowance method, that we have the revenue or the income statement approach, or we have the balance sheet approach. The income statement approach is simply taking a percentage of revenue and recording the debit to your bad debt expense and a credit to allowance for that calculation. 10% of your sales. That's it, you're done. But on the balance sheet method, we have to create an ending balance, or we have to create an estimate of the ending balance in our allowance account. Once we determine what our allowance account ending balance should be, now we can make the adjustment, because we tend to consider, 1, what balance already remains in that account and record the difference if they're both credits. If they're debit and a credit, meaning the debit balance is already in your allowance account and you want to change that, or your allowance has to be an overall credit balance, we add the two together to come up to our adjustment. With the aging of receivables, coming to that number is just a matter of calculating what percentage of the receivable is going to be outstanding or uncollectible at various points, 30 days, 60 days, 90 days, etc., and adding them together, again, giving you the ending balance that you would need in the allowance account. I really hope this short video was helpful to you, and if you have any questions, by all means, please ask. Thank you.